Multinational corporations legally move billions in profit across borders using internal transactions. This mechanism, known as transfer pricing, determines the price charged when one subsidiary sells goods, services, or intellectual property to an affiliated entity in a different jurisdiction. If a German manufacturing unit sells components to an Irish distribution hub, the price set is not market-driven but internally determined. Setting this price too low in the high-tax country and too high in the low-tax country effectively shifts taxable income. The core objective is tax optimization, exploiting differences in corporate tax rates globally. This practice is entirely legal, provided the prices adhere to international standards designed to prevent excessive erosion of the tax base. The stakes are enormous. Governments lose trillions annually, prompting aggressive audits and complex legal battles over the definition of fair value. The foundational rule governing all transfer pricing is the arm's length principle, codified in Article 9 of the Organization for Economic Cooperation and Development Model Tax Convention. This principle mandates that transactions between associated enterprises must be priced as if they were conducted between independent, unrelated parties under comparable circumstances. If the internal price deviates from this hypothetical market price, tax authorities can adjust the taxable income. Proving arm's-length compliance requires rigorous economic analysis, comparing the controlled transaction to uncontrolled comparables. The challenge lies in the inherent uniqueness of intragroup transactions, especially involving proprietary technology or specialized services, making true comparability often elusive. Failure to meet the arm's-length standard results in tax adjustments, penalties, and potential double taxation if the corresponding jurisdiction does not agree with the adjustment. Transfer pricing methods are categorized into traditional transaction methods and transactional profit methods. The comparable uncontrolled price method, or CUP, is the most direct and preferred method. It compares the price of the controlled transaction directly to the price of an identical or highly similar transaction between unrelated parties. However, finding perfect external comparables is rare. The resale price method is often used for distributors. It starts with the price at which the distributor sells the product to an external customer, then subtracts an appropriate gross margin, determined by comparing the distributor's margin to margins earned by comparable independent distributors. This residual amount represents the arm's length price for the initial sale from the manufacturer to the distributor. Both comparable uncontrolled price and resale price focus on gross margins or prices, requiring high functional comparability. When reliable external price or gross margin data is unavailable, transactional profit methods are employed. The cost-plus method is typically applied to manufacturers or service providers. It takes the supplier's cost base and adds an appropriate arm's-length gross markup, derived from comparable independent suppliers performing similar functions. The Transactional Net Margin method, or TNMM, is the most frequently used method globally. Transactional Net Margin method examines the net profit margin relative to an appropriate base, such as sales, costs, or assets that an associated enterprise realizes from a controlled transaction. This net margin is then benchmarked against the net margins of comparable independent companies. Transactional net margin method is less sensitive to functional differences than gross margin methods, but requires careful selection of the tested party and the profit level indicator to ensure accuracy and compliance. Intangible assets, including patents, trademarks, software copyrights, and proprietary know-how, represent the largest source of profit-shifting controversy. Multinationals often centralize ownership of high-value intellectual property in low-tax jurisdictions, such as Ireland or the Netherlands, through cost-sharing agreements or buy-in payments. The manufacturing or sales entities then pay substantial royalties to the intellectual property owner, effectively moving profit out of the operating country. The challenge is valuing these unique intangibles, especially when they are developed collectively across multiple jurisdictions. The Organization for Economic Cooperation and Development now emphasizes the concept of DEMPE: development, enhancement, maintenance, protection, and exploitation. Only entities performing and controlling these key functions are entitled to the residual returns generated by the intangible asset, shifting focus away from mere legal ownership.
Intercompany services cover everything from centralized information technology support and human resources management to complex research and development activities. For low-value adding services, such as routine administrative support, the Organization for Economic Cooperation and Development allows simplified approaches, often permitting a small markup, typically 5%, on the costs incurred. However, high-value services, like strategic management consulting or proprietary engineering, must be priced using standard arm's-length methods, often the Transactional Net Margin method. A critical requirement is the benefit test. The recipient entity must actually need and receive a measurable economic benefit from the service, similar to what an independent enterprise would pay for. Services deemed merely shareholder activities, such as consolidating financial statements for the parent company, are not chargeable to subsidiaries. Transfer pricing extends beyond goods and services to financial transactions, including intercompany loans, guarantees, and cash pooling arrangements. When a subsidiary borrows money from its parent company, the interest rate charged must be arm's length, reflecting the borrower's credit rating and the specific terms of the loan. Multinationals often use high-interest intercompany debt to strip profits from high-tax jurisdictions, as interest payments are typically tax-deductible. To counter this, many countries implement thin capitalization rules, which restrict the amount of deductible interest expense based on debt-to-equity ratios or earnings before interest, taxes, depreciation, and amortization thresholds. Furthermore, intercompany guarantees must also be priced appropriately, reflecting the financial benefit provided to the guaranteed entity, often calculated using a yield approach or a cost-savings approach. Compliance requires extensive documentation to justify the arm's-length nature of all controlled transactions. The Organization for Economic Cooperation and Development's three-tiered documentation structure is the global standard. The master file provides a high-level overview of the multinational group's global business, organizational structure, and overall transfer pricing policies. The local file details specific transactions involving the local entity, including functional analysis, economic analysis, and selection of the transfer pricing method. The third tier is country-by-country reporting, or CBCR, which requires large multinationals to report key financial data, including revenue, profit, taxes paid, and employees, for every jurisdiction in which they operate. Tax authorities use country-by-country reporting data to identify high-risk areas for audit, focusing on entities with high profits but low tax payments. The global response to aggressive profit shifting is the Base Erosion and Profit Shifting Project, or BEPS, led by the Organization for Economic Cooperation and Development. Base erosion and profit shifting introduced 15 action items aimed at aligning taxation with economic substance and value creation. The most transformative recent development is the two-pillar solution. Pillar 1 addresses the allocation of taxing rights to market jurisdictions, moving away from physical presence requirements. Pillar 2 introduces a global minimum corporate tax rate of 15% for large multinational enterprises. This global anti-base erosion, or GLOBE rule, ensures that if a multinational's effective tax rate in any jurisdiction falls below 15%, a top-up tax is applied, fundamentally limiting the effectiveness of traditional low tax havens for profit shifting. Technology is rapidly transforming transfer pricing compliance and enforcement. Advanced data analytics and artificial intelligence are now used by tax authorities to process vast amounts of country-by-country reporting data, identifying anomalies and potential non-compliance patterns far faster than manual audits. For multinationals, specialized transfer pricing software automates the benchmarking process, sourcing comparable company data from commercial databases and calculating arm's-length ranges dynamically. Blockchain technology offers potential for real-time, immutable recording of intercompany transactions, enhancing transparency and reducing disputes over transaction dates and volumes. The future of transfer pricing involves continuous transaction monitoring, moving away from annual compliance checks towards integrated, automated systems that ensure prices remain within the arm's-length range throughout the fiscal year.